So card company has in issue 8 million shares with an ex-dividend market value of 7.16 per share. Okay. A dividend of 62 cents per share. So they make a dividend payment of 62 cents. Fine. And this is very important information. So dividends, what they are paying is around 62 cents. Now, the pattern of recent dividends. So dividends, what they are paying is they have been paying the dividends in this form. In 2010, they paid this much dividends. In 2011, they paid this much, 13, 14. We are seeing growth in dividends. Okay, this is important and relevant data you need to remember, because what they are asking in the question, they're asking to calculate the cost of equity of card company using dividend growth model. So all this data is very relevant. Okay, just give me a second. Just a second. So the information is very relevant, and they're asking you to find out the cost of equity. And for that, they are asking you to use which model? Dividend growth model. So can you tell me the formula for dividend growth model? Any one of you? Yes.
Dividend by price, sir. If growth is involved, dividend into 1 plus growth by price minus growth.
So cost of equity as per dividend growth model is D naught, the dividend which has been paid, just been paid, into 1 plus growth factor, which is nothing but equal to D1 as well, whole divided by P naught, the share price, plus the growth factor. Okay. So for all this, we have one data, that is 0.62. We know the dividend. We have to just get the growth factor. We have one more data. What is the share price given to you in the question? The share price is 7.16. The only data we don't have is the growth. So we can find out the growth. Okay, how will we find out? See, what is your latest dividend? 62. What was your, I'm not taking 0.62 because, the direct values are given. And what was the last dividend they paid? Like they started the dividend payment from 2010. 55.1 whole power. The dividend has grown how many years from this point when they made the dividend payment at the end of 2010? 1, 2, 3, 3 years. So whole power 1 by 3 minus 1. That is dn by d naught. Dn is like, the future dividend which is paid in the first year, whole power 1 by n minus 1. So can you calculate and tell me the value, please? Can you tell me the growth factor fast? And we'll put in this formula and we'll get the first question's answer.
$1.040, sir.
Yeah.
So 4%.
Yeah, 4%. If you just, like here, 62 divided by 55.1, power 0.3333. I'll take, just a second. 62 divided by 55.1, power 0.3333. 1.04 you'll get minus 1 into 100 is 4%. The growth is 4%. We'll just put it in this formula. 0.62 into 1 plus 0.04 whole divided by 7.16 plus 0.04. Just find out and tell me the cost of equity, all of you.
0.12, sir. It is 12%.
0.62 into 1.04 by 7.16. We'll just do the calculation part. 0.62 into 1.04 divided by 7.16 plus 0.04. It's 0.13 into 100. It is 13%. Please have a look through. Once check your answers. It is 13%. Everyone got this? Shall we move forward? Hello? Okay. Now, what is the next set of data? Card company also has in issue 8.5% bonds redeemable in 5 years. Time with a total nominal value of 5 million. That means the nominal value of the debt is 5 million. See, I would always tell you something. What is relevant in cost of capital is market value. Okay. The market value of a $100 bond is 103.42. This is the market value of bond. That means the bond is trading at 103.42. This is relevant for us. Now, redemption will be at nominal value. Everyone knows that whether the bond is trading at premium or discount, it is always redeemed at par, that is $100. Now, what is the next set of question? Card company is planning to invest a significant amount of money into a joint venture in a new business area. So they are looking up and they want to start a new business. For that, they want to go into a joint venture. So for that, they have to invest money and they are looking like new business, okay, opportunities, and they are looking for some partners whereby they can have collaboration with them and they can start a business. So it is identified a proxy company with a similar business risk to joint venture. That means, see, they have to, what are they asking? The next question, discuss whether the dividend growth model or CAPM model, this is theory question you have to answer. Calculate a project specific cost of equity for card company. So if we want to find out the KE for card company, and that to project specific, what is project specific? You are looking up for a new project like joint venture. From that project, what is the return you are going to get? That they're asking you to find out. Okay. So for that, they have given some data. Please understand this data, very important data it is. We will do the calculation. So card company is planning to invest a significant amount of money in a joint venture in a new business area. It has identified a proxy company with a similar businesses. That means they want to start a business. They want to go into a joint venture, and the kind of business what they're looking up to take up. Okay. They want to find out the systematic risk in that business. To know the systematic risk in that business, we or to want to find out the, they want to find out the return from that business, right? To find out the return from that business, they have to use a formula of CAPM. What is the CAPM formula? return on equity is equal to, or cost of equity is equal to, just a second, this give me some problem. Yeah, what is the formula? RFR plus just wait. What's the formula for CAPM? RFR plus beta into RM minus RF. Everyone, yes? RFR plus beta into RM minus RFR. This is the formula for CAPM. For this formula, we require this project specific beta. For finding out this project specific beta, we will take a company as our base. Okay. So for that, they are giving some data here. Please understand. So card company is planning to invest, everything is given. The proxy company has an equity beta of 1.038. So they have an equity beta of 1.038. What we will do, we will first find out the asset beta. Okay, that means we will take the beta of this company and remove the financial risk whatsoever in this company. And then that means we'll first ungear this company beta, and then we will regear it with our own financial risk. Okay, and then find out the project specific beta. Everyone, please tell me, you are familiar with this kind of terminologies? We have already discussed everything in the class. Okay, so let me do the ungearing part. I'm asset beta, equity beta into just give me a second. Equity beta into value of equity by value of equity plus value of debt into 1 minus tax rate. So we will do this, we will do the calculation part. Everyone should follow. What is equity beta given in the question? 1.038. 1.038 into value of equity. So we know the debt to equity ratio of this company. What is the debt to equity ratio? 75% financed by equity and 25% by debt. So 0.75 by 0.75. Everyone put this plus 0.25 into 1 minus tax rate. What is the tax rate given to in the question? 30%. All of you do the calculation. Tell me the answer, please. 1 minus. Tell me what is the asset beta? All of you. Hello. Hello. Is everyone solving? I'm asking you a question.
Yes, sir, we are calculating.
Yeah. Please do tell me the answer.
Sir, I got 0.841.
Yeah, so 0.841 is your asset beta. Now what we have to do, this is we have ungeared this. That means we have removed the debt to equity ratio of the company which we have taken as a target. Okay. First ungearing, then regearing, then we will take our debt to equity ratio. Okay. And we will find out our project specific beta. So now what we'll do, equity beta is equal to 0.841 0.841. The formulas are given to you in your books itself. Whole divided by this formula. Okay, because you are finding out equity beta. So equity beta is nothing but asset beta divided by all this. Asset, see here, equity beta into all this is asset beta. Now you want to find equity beta, asset beta you've got. So asset beta is 0. You've got the asset beta, you've got the asset beta. Now asset beta divided by whole this right hand side factor will give you equity beta. So I'm taking asset beta. This answer is still here. Now I've taken the asset beta and I'm going to take the debt to equity ratio of our company. So we will take the data here. So the current risk-free rate of return is given, and card company pays a tax of 30% every year, and they have the and has an equity beta of 1.6%. Okay, they are taking up a joint venture project. They are finding out the project specific equity beta. For that they want to take up their debt to equity ratio. So what is their debt to equity ratio? So first we have taken the proxy company's beta. We have taken the proxy company's beta and we have ungeared that. Okay, here we can see proxy company's beta was taken. Its equity beta is 1.038, correct? So we have taken its equity beta 1.038. We have ungeared it. Okay, that means removed its debt to equity ratio. And then we got the asset beta. Now we will re-gear this with our debt to equity ratio to get the project specific beta. Okay, let's do this. So for that, we need the debt to equity ratio. So see, card company has in issue 8 million shares with an ex-dividend market value of 7.16. So 8 into 7.16. How much it is?
It's 57.2.
57.28. And after this, we have to take the debt finance also. What is that about debt finance they have given? Let's see that. Card company has in issue 8.5% bonds redeemable in 5 years time with a total nominal value of $5 million. Market value is 103.42. So they have, if you take 5 million, 5 million is how much? 50 lakhs. Divided by 100. How many bonds will be there? 50,000 bonds will be there into 103.42. This will give you the market value of the entire debt. Okay. So what is the market value? First, for that, you need to find out the number of bonds. So 5 million is 50 lakhs. 50 lakhs divided by 100 gives you 50,000 bonds. Into 103.42, it is 51 lakhs 71,000. Okay. So I can tell 51.71. 51.71. So we've got debt equity both. Now can we find out our project specific beta? Yes. So all of you take this. How I did, 5 million is 50 lakhs. 50 lakhs divided by 100 is 50,000. 50,000 into 103.42. Let's move forward now. So now we will put the debt to equity of the company, the joint venture in which we want to invest, because for that joint venture business, we have taken the proxy company's beta as our, as a target to find out our beta. So what we did first, we ungeared that we took the proxy's beta, we ungeared it. Now we are regearing. We are again, adjusting this with our debt to equity ratio, our leverage. So what is the debt to equity ratio? Equity was how much? 57.28, right? It was 57,280, and this is 5171. I'll just write it, 57,280. This is 8 million. Okay, 8 million shares. 8 million shares into each share is trading at 7.16. So 8 million is 80 lakhs. So 57,280, 3 zeros omitted. This is your equity. Your debt is, if you take it like 5171, if you multiply 50,000 into 103.42, you can do that. So I get 51 lakhs 71,000. I remove 3 zeros, it is 5171. So I'll take this all in this data. So we know the formula, it is 52,780. All of you do it simultaneously. Whole divided by 52,780 plus 5171 into 1 minus 0.30. All of you please calculate and tell me what is the equity beta, project specific beta, please, fast. Sorry, how much?
It's 17,236.
Oh, it is a 0.841 divided by 57,000, 52,780 by 52,780 plus 5171 into 1.0.30. You have to solve everything, you'll get the answer. Fast, because we need to find out the cost of equity for that project.
0.899.
0.899. That's great. Correct. So what does it mean? We have found out the project specific beta. By taking this project specific beta and putting it in CAPM equation, we can find out the cost of equity from this new joint venture project. Okay. Because in the question, what they have done, they have first asked you to find out the cost of equity using dividend growth model. We did that. Then second phase, what they said that company is planning to invest their money in a joint venture. That joint venture, what they are, looking up to, they don't know how much returns that joint venture is going to give them. To find out the return from that joint venture, okay, they will use CAPM model to do that. If they use CAPM model to find out the returns from that particular joint venture, the formula for CAPM is expected return, risk-free rate plus, I've already given the formula, risk-free rate plus beta into market return minus risk-free rate. Everything is all right. Risk-free rate is given the question. That is standard for everything, every business. Beta factor of card company is given. Don't get confused with that. Card company is different. See, current risk-free rate is given, average risk premium is given, card companies cost of equities, card companies equity beta is given. We are nowhere concerned with card companies equity beta. Why we are not concerned with card companies equity beta? We are finding out the cost of equity or required rate of return from the joint venture business. Card company itself is a company. Okay, they are looking for a new investment. When they are looking for a new investment, they want to find out the return from that new investment. To find out the return from that new investment, they want the beta with respect to that investment. So now the challenge was, this is given, this is standard for every business, market returns are standard for every business, but beta, it differs from business to business. So card company's beta is 1.6. Card company is a listed company maybe, but the company which they are looking to invest, the joint venture company, is a new one. So for that, they have searched, or they have got a proxy company which has a very similar kind of business. So that shows that company and the company which these people are looking into to invest, or the new joint venture business they're looking to do, they have similar business characteristics. So they picked up its beta, okay, as a target. What they did, they took the beta of that proxy company, they ungeared it. That means they removed the debt to equity ratio of that company from this beta, and they got asset beta. Now with that asset beta, they are finding out the asset beta was 0.841. They are again re-gearing this asset beta with their debt to equity ratio. With their debt to equity ratio is nothing but, the financial risk will be different from different, okay, for different businesses. The business risk will be same, but financial risk will be different. So they have to take their debt to equity ratio for that. Okay, so they did that. Data is clearly given. And what they did is they found out the equity beta, the project specific beta. Now this project specific beta we will take, and we will find out the cost of equity. Now cost of equity is equal to 0.04 plus risk-free rate plus 0.895 project specific beta into risk-free rate minus market return or market risk premium is given to you. That is 5%. You will get the answer. Please do this and tell me the answer.
Sir, 0.899.
899. Yeah, that's okay. You can write it. I heard 0.895. If it is 0.899, you can write 899. That's okay. At sometimes you may be looking at market returns and risk-free rate, and difference of market return and risk-free rate is risk premium. But in this question, they have directly given the risk premium. So no need to do that. Directly you can take 5% here. Tell me the answer.
8.5%, sir.
8.5%. This is your answer. Done with the question. Just have a look through. Any doubts you can ask me. This is card company's beta. Okay. Now we have calculated the project in which card company wants to invest. That project specific beta we have calculated. That project's specific beta. So you should be knowing this fact. Don't get confused with card company's beta, which is already given. You are going to find out the project specific beta. Only the joint venture related projects specific beta. Specifically for that project. And that project's investor is card. So we will take the card's debt to equity ratio in this case. Understood? That joint venture investor is card. It's a joint venture. Okay. So these people are going to invest. So their debt to equity ratio. So we are done with this question. We are going to start another question. They have given only 2 practical questions, which I have covered. Rest of the 2 questions are theory. You have to look into that. Okay. We have only 2 minutes. I'll close the meeting and give you one more link. We are going to do this question now. Everyone get ready. There is one question called Dilda. I'll send you that right now, the screenshot of that question right now. Okay. Be ready. Yeah. I'm giving you a meeting link in 5 minutes. Thank you.